this mistake, if you mess this up and don't optimize it, you could cost you and your family thousands, if not hundreds of thousands, if not millions of dollars just by having your asset allocation set up incorrectly to your plan. That's how important asset allocation is to a 401k. And the reason is your 401k is designed to be contributed to for decades, right? And so if you let something go on for decades wrong, it's going to go in the wrong direction and you're going to have a problem.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me.
Cory, we've got a powerful topic today, all things 401k management. Before we dive in, do you have any thoughts? Anything you want to share with the audience? I know we usually save that to the end, but you got anything you want to share? Because we could dive right into this sucker.
Let's dive right in. Let's talk about the 401k and how
That's
to
why they
it.
clicked on this link, Cory, right?
That's right.
Today's topic are ways to optimize your 401k. Cory, I've got a list here of optimal strategies, but first, you being my guest, why don't you kick us off?
I think that optimization, Jake, to me, for the sake of our conversation, a lot of it has to do with the optionality that you're giving yourself. And I think when we're talking about optimizing 401ks, I think that you need to think about current and future tax rates. And you need to recognize that optimizing your situation today is really about giving yourself optionality in the future as life happens and things change.
Look at that. Very complicated start here.
Start us off early.
So what you're talking about in English is you're saying you need to select between the pre-tax, after-tax, or if your 401k offers Roth version. Why don't you explain those in English to our audience, Cory?
Yes. Yeah. So when you are making pre-tax contributions to a 401k, you are making a bet that your tax rate is going to be lower in retirement than it is when you're making those contributions. Like, to keep it very simple here.
That's what this show should be simple, Cory.
Which may or may not be true, but that's basically what deferring the income now is betting that tax rates are going to be lower.
And that's normally the default, right? So if you don't choose anything in your 401k, your normal default is it's going to deduct your contributions from your paycheck before you pay taxes. So it's going to come out pre-tax and go into that 401k. And Cory's right. You're basically making a bet that you think your taxes will be lower in retirement, which isn't always the case. But go ahead, Cory. Keep going.
Exactly. So that's one piece of what I'm talking about as far as the optionality goes, those pre-tax contributions. Roth 401k contributions, on the other hand, Jake, are something that has become much more relevant and prominent just in the time that you and I've worked together. In the last 15 years, I've seen far more clients that have that option available, where that's doing the opposite. It's paying the taxes on the front end, basically paying taxes on the dollars that you earn now. The money's going into the 401k after taxes in the Roth piece, but it can then grow tax-free from that point forward. So again, a lot of it has to do with current tax rates, future tax rates, your situation now, and what you think your situation is going to be later.
Yeah, and I don't know the numbers on this, Cory, but I don't know what the numbers are, so I don't want to misquote it. But not every 401k has the Roth 401k option, so you're going to need to check with your HR, your benefits department. It is becoming more widely in
routine
401k plans. Like more clients that I meet with have this option, but not everybody does. So again, that's something that you definitely want to check in with. Again, this bet would be that you're thinking you may be in a higher tax bracket in retirement. And then, Cory, there's a third one, the straight up after tax. You want to explain that one?
Yeah. So after tax contributions, those are dollars that are going in, just like the Roth, where you're paying taxes on the front end. The earnings on those dollars inside of the 401k, those earnings grow tax deferred, just like the dollars do that you would contribute before taxes in the first place. The difference is that those earnings are growing tax deferred on top of dollars that you've already paid income tax on.
Yeah, but they don't come out tax-free as a Roth.
Correct.
So you have to be careful. Like, after tax is not the same as Roth. So again, this is again, we've got a little bit of a conflict of interest, but this is why, in my opinion, Cory, it pays to hire a wealth advisor. Of
course.
Especially a chartered retirement planning counselor that talks about this stuff every day. So you've got generally three potential options, right? So you've got the pre-tax, you've got a Roth maybe, or you've got an after-tax. And so all of those are actually a little bit different. And what we're trying to mitigate is your tax exposure in retirement. So if you put all your money in pre-tax, you're basically putting all your eggs in one basket, which everybody knows that's a big no-no. And so
Mhm.
we like something called tax diversification with our clients, where we maybe do some in pre-tax, maybe some in after-tax, some in Roth. Generally, we like the Roth better than the after-tax, but everybody's situation is different. So you have to be careful of that also. But that's a good point, Corey. Great way to kick us off. And the key here, though, is that we don't know what the tax brackets are going to be during hopefully a multi-decade retirement period. So you can't say with confidence if you're going to know your bracket's going to be higher or lower. Nobody can actually answer that question.
That's right. And
So
that's why this planning and the tax diversification is so crucial. I'm glad you said that, Jake, because you're spot on.
yeah, good one, Corey. All right. So tax diversification is one way to optimize your 401k. Again, we plan because we can't predict. That's very important for our audience to understand, that is that we plan because we can't predict the future. So that's why we want to mitigate, diversify, and not put all our eggs in one basket. Corey, I thought the obvious one, the number 2 here, is to optimize your 401ks to get the free match.
Mm,
You jumped right over that, which is fine.
I
You're my
did.
guest. You can say whatever you want on this show.
Thank you.
So the free match, you are literally giving up money. So if you have to put in 6% to get 3%, if you have to put in 8 to get 4, if you have to put 10 to put 2, whatever it is, make sure you're aware of what the rules are with your 401k. It's called a summary plan description. You should be familiar with that. If you don't want to read it, you should send it to your financial planner. Our financial planners are happy to study those summary plan descriptions for you and break it down. And like I talked about, Corey, here in English, and let you know what it means. But you got to make sure that you're getting that match. I would even tell our younger audience that you can't afford not to do it. If you say, Jake, I got a mortgage, my wife had a baby or whatever, I can't do it, I just can't afford it. I'm telling you, this is such a strong return on your money and such potential for compound interest to work in your favor. You are a fool if you are walking away from a free match. And I know that's a harsh statement for me, Corey, but I just hate to see if somebody only needs to put in 6% to get 3, they gotta find a way to do it. You have thoughts on this?
Yes. Yeah, that might be harsh, Jake, but it's real. So I agree with you there. And I think it's okay to be harsh in that regard. That yes, if you need to treat the match, if you have a match from your employer on a retirement account that you contribute to, you need to treat that as part of your compensation that you are actively choosing to leave on the table by
Right.
not saving a little bit of money now for yourself for the future, especially if your company is going to match at least a portion of it. But either way, regardless of what tax rates look like in the future and everything else, like the reality is you're going to need money, right? You're going to need money one way or the other.
Like you said, it's like your employer said, all right, Corey, we're going to pay you $100,000 a year. And you said, nah, you know what? I'm only going to take 95.
Right. Your employer would say, okay.
Yeah, exactly. So again,
we'll pay you
take
less.
advantage of that match. Now, another big misconception, we'll call this 2.1 version 2.1 of optimizing your 401k, Corey, because it's a little bit of the same, is that people think, so let's say you make $100,000 to make the math easy. Let's say you need to put 6% in to get the match. Okay. Just to use rough numbers, whatever. So it's $6,000 of your own money you're putting in, right? Theoretically. And then you get a 3% match. So the company's going to kick in another $3,000. Well, you're putting in $9,000 with the match. Some people think, Corey, that is maxing out their 401k because they're getting the match. That's not how it works. The IRS actually says you can put quite a bit more than that. And it changes year to year, but it's over $20,000 of your own money can go into that 401k. So what I'm talking about here on option 2 to optimize your 401k is to take advantage of that free match, but that does not mean you're maxing it out. So you also need to be aware of what the IRS limits are. And if you can afford to put more in, and if your financial plan says you need to put more in, then by all means, put more money in. So again, that's 2.1 here. So number 1 was tax diversification from Corey. Number 2, get that free match and then understand what the IRS rules are. Don't think you're maxing it out just because you're putting in 6%. That's not how it works. Unless you're making enough income that is 6%. But you have thoughts on this, Corey?
No, I think that's exactly right. I mean, I think that you are highlighting that in a way that makes very clear sense, and that you should take full advantage of that match, but recognize that you can max out your contributions to max out the match the company gives you, but that is not, in all likelihood, the dollar amount you're limited that can actually go into the account on a year-to-year basis. It's just like, Jake, if If we talk to someone about investment returns and what someone's financial plan is averaging, it doesn't mean they can't make more money than that. It just means that's the average, right? So the idea here is it doesn't mean that you can't contribute more. And I'm yet to run into a client. It's like, Cory, I just have too much money.
Well, it could happen, I guess.
Yeah.
All right. What's number three? What's number three, Cory?
So I think number three here, as far as optimization goes, is actually how do you integrate, Jake, that 401k, which is the primary vehicle that people in the United States use to save for retirement? How do you integrate that into your financial plan? That one way you can actually optimize your 401k for the future is to understand how it fits into your financial plan, along with your Social Security, along with your pensions, along with your spouse, healthcare costs.
What do you mean fit in?
Else.
Break that down in English.
What I mean is that your 401k does not exist in a vacuum. Like when you were thinking about how you're saving for retirement, it's one piece of the puzzle. So my point is to really optimize and get the most out of your 401k, you should understand how it fits into the bigger strategy of your long-term financial plan. And that's where you can really start making those choices to optimize, like even doing you just can't make decisions around the 401k explicitly because it is part of the bigger picture as far as retirement planning goes.
I see. So you don't leave it out of the plan. So you incorporate it in everything that you're doing around. So you're not even talking about the investments here. You're talking about taking, like you don't want to manage your 401k in a vacuum.
That's it.
Is what you're saying. That's because I think some people do that actually, Cory.
They absolutely do.
And a big mistake I see people make, actually one of the number one mistakes I see people make when they're treating their 401k like a vacuum is they'll use that and they'll compare that against maybe an IRA or brokerage account return where they've got them invested completely differently. So of course the returns are going to be different.
Right.
And again, you might want to take more or less risk in a different type of account based on your financial plan and what that account is earmarked.
Yeah, in fact, you probably should.
Right.
You probably should be.
Yes. Yes. So like you should use a high yield savings account for short-term goals. If you want to buy a boat, Cory, your kitchen remodel, if I'm going to buy a car, we use high yield savings accounts for those types of goals. So over a long time period, I expect my retirement accounts to outperform my high yield savings account. I am not comparing performance on those two accounts because they're for two different goals. So again, I like what you said there. I didn't have that written down on my list. So again, making sure that 401k is not treated as an isolated account, that you're working that in your financial plan with all of your other investments, all of your other liabilities, all of your other goals, and making sure that it is incorporated and has a very specific, goal tied to that 401k so that it can be incorporated into the plan accordingly. Nice one, Cory.
Yeah, thank you. I mean, really connecting those dots, like you've got to zoom out and look at the bigger picture. And like that is how you can, that's how you do real financial planning, right? That's how you can optimize the 401k.
Using the real financial planning. I like it, Cory.
Yes, thank you.
All right, good. I got another one for you. But let's take a commercial break, Cory. So again, thank you as always for joining on my show. And thank you to all of our audience out there. Our subscriber count continues to grow. If you think our content's any good, please give us a 5-star rating or a thumbs up. I think that helps the algorithm get Upticks out to more people. If you want more content out of me and Cory, please follow along to each of us on Instagram. My account is under Jake_Falcon_CRPC, and Cory's is simply Cory Bittner KC. So thank you all out there for tuning in. We love creating Upticks, and the whole point of Upticks is to enhance financial literacy. Also, if you have a show topic that you would like us to discuss live here on Upticks, simply email our communications manager, Luke at falconwealthadvisors.com, and Luke will make sure that we discuss your content idea. All right, Cory, is it my turn?
It's your turn.
All right, so this one I kind of alluded to a little bit, but another way to optimize your 401k, Cory, would be to make sure that your asset allocation is set up appropriately with your financial plan and its goals. This is a big one, Cory, because a lot of people think that if they just set it and forget it, you're too young to know Ron Popeil. You know Ron Popeil? Is that his name? Do you know what set it and forget it is? Have you ever heard of this?
Yes.
What is it?
Yes. I at this point, it's an expression that I've heard a lot for 15 years.
Do you know what it is?
I don't remember what the origin is. It has something to do with plants, right? Planting.
No, planting.
Yeah, I'm way out over my skis here. Educate me.
Popeil, I think that's his name. Popeil, I don't know. He was a famous infomercial guy, and he sold these. I think they were these like microwave ovens, and you just set the timer, Cory, on your bagel or your toast or what. Set it and forget it. You're too young. You never saw that, did you?
No, I was just Googling it right now, Jake. You're right. It looks like it was a Ronco. Does that sound right?
Yeah, I don't know. Set it and forget it. You don't know that. That's fine. Anyways,
I know the expression.
your
but go on.
401k, Cory, here's a news update. Your 401k, Cory, is not a microwave oven. Did you know that?
Thank you. Now I do.
So you don't, like a lot of people, Cory, when they're 25, 35, 40, I don't care. When you started working, you may have set up, you may have looked at it. Heck, it may have been defaulted to an asset allocation that is no longer relevant. And I'm talking, Cory, this mistake, if you mess this up and don't optimize it, you could cost you and your family thousands, if not hundreds of thousands, if not millions of dollars just by having your asset allocation set up incorrectly to your plan. That's how important asset allocation is to a 401k. And the reason is your 401k is designed to be contributed to for decades, right? And so if you let something go on for decades wrong, it's going to go in the wrong direction and you're going to have a problem.
Yeah.
And there's another reason, Cory, I don't like target date funds because target date funds are a very cookie cutter way to do things. And they don't know anything about your financial plan. So I don't like target date funds. The audience knows I don't even like mutual funds, but if that's all you have available, so be it. But again, the key driver of long-term performance, though, is that asset allocation. And you want to make sure that you have that appropriately aligned with your financial plan. It can make or break your retirement. It really can. If you've got your 401k set up too conservatively or too aggressively, you run the risk of screwing everything up. And then what's the point of even contributing if you're going to have it invested wrong? I can get a little soapboxy on this, Cory. But you have any thoughts on this you want to chime in on?
Yeah, I think we've highlighted here, Jake, that using a 401k to save money for the future is probably going to help yourself financially in the future, right? Taking advantage of the match. There's ways to optimize pre-tax versus Roth versus brokerage. But to your point, once you've began to make contributions, how the money's invested is crucial also. And optimizing the investment options that you have. And the reality, Jake, that we see is that we have clients that retire with millions of dollars in their 401ks. For a lot of them, that's the largest, outside of maybe their home, for example, that's the largest asset that they have on their balance sheet. So just to your point, picking a target date fund, setting it and forgetting it, assuming that, tax rates in the future is all just going to look the same that it has in the past. You don't want to dismiss your 401k or not give it enough care, particularly if it's going to be the most important part of your retirement plan. And the way that you can optimize on that can change, because Jake, in the 15 years that we've worked together, I remember when Roth 401k options were barely a thing. People barely had that option available to them. And now people have mega backdoor Roth options inside their 401ks. That's how much things can change in a relatively short period of time, that you want to check in on your 401k and make sure that you are optimizing it to its full effect and that the money's invested properly.
All right. Here's another quick plug, Cory, is that we at Falcon Wealth Advisors, we've actually have the technology. So if you don't want to mess with your asset allocation, you don't want to monitor it, you don't want to manage it, you don't want to worry about it being aligned with your financial plan, you can actually hire us and we can align that 401k with your financial plan, and our traders can actually rebalance and manage that for you, which is pretty cool. Not all advisors have this capability. And so it's a neat offer that our clients are taking advantage of. I think we have over 100 clients that we're doing this for, Cory. So again, if you're tired, Cory, of ignoring your 401k and you recognize that you need help, please reach out, send us a message, email Luke, whatever you want to do. We're happy to set up a meeting. We can take a look at your asset allocation, take a look at your 401k, take a look at your financial plan. And that's what we're here to do. We're here to help people. And it's a big deal getting that asset allocation set up correctly.
Yes.
All right, Cory, you got another one?
I do, Jake, and you can check me on this, whether this is optimizing your 401k. But I think optimizing your 401k is having it attached to a plan that you can actually stick to. And what I mean when I say this is that there are a lot of great plans that are made on paper that can fall apart emotionally when the market drops, somebody goes into retirement without purpose. So my bigger point here is recognizing that the 401k is a tool, but what you're using the money for and what you build with it, that's really what's important. And I think when we're talking about optimizing investment options, taxes, and everything else, but again, just sort of zooming back out and recognizing that you want to use that asset inside of the context of a plan that you can actually stick with. because a lot of this stuff can sound good on paper.
Aren't you saying the same thing you already said?
I don't think so.
So tell me more. I don't understand what you're saying here.
So what I'm saying is you want to integrate your 401k into your financial plan. And then
you already said that.
Correct. And then I'm also saying that you want to have a financial plan that you can stick with, and you want your 401k to be a crucial part of that.
So you're saying when markets get turbulent, you don't want to throw your plan and your 401k strategy out the window. Is that what you're saying?
Yes. And my point is, though, the 401k itself, Jake, just like an IRA or a Roth IRA or an HSA or insurance or whatever else, it's just a tool, right? But like it's designed for accumulation, but the decumulation part of what it is that we work with our clients on actually spending their money, all that money they stocked in the 401k for 30 or 40 years, like what do you want to do with it now? And what if the future looks different than the past? Like that's where there's a lot of work that's involved. And that's where I think that recognizing that having a plan that you can stick to in your 401k fitting into being part of that is important. And I guess, Jake, now that I'm repeating it again, it does sound a lot like what I said
stretching
earlier.
it, Cory.
It sounds a lot like what I said earlier.
I got another one. So this is a way to optimize your 401k, Cory, is to not borrow from it. You know, a lot of people will dip into that cookie jar, Cory, because an emergency or they want to buy a boat or a car, and they hear, well, I'm just borrowing from myself and I'm paying myself back. What's so bad about that? I'll tell you what's bad. That if you have $100,000 in your 401k and you're borrowing $50,000, well, now that you only have $50,000 in there to take advantage of compound interest. And so if you make 10%, this is just for illustrative purposes only. None of this is guaranteed, blah, blah. This is not investment advice, right? I would be clear with disclosures here. But let's say you have $100,000 and you make 10% in 1 year. Well, then you make $10,000. But if you have $50,000 and you make 10%, you're only making $5,000. So yeah, you're technically borrowing from yourself, and yeah, you're paying yourself back, but you're just putting yourself way behind from a compound interest standpoint. And people like you and me, Cory, will argue that compound interest is one of the greatest phenomenon of math and mankind, and the ability to take advantage of that is life-changing. And so you are drastically hurting yourself when you borrow from your 401k. So instead, I like to see clients with an emergency savings and a brokerage account, even a home equity line of credit potentially, or getting a mortgage, right? Finding other ways to tap equity, not from their 401k. The 401k actually should be the last place because, again, of this compounding nature. So I don't like seeing people, you put money in that retirement account and you know that's what it's for. Like you talked about already, like it's in the plan for my retirement and that's it. Just like my high yield savings account, Cory, that I used was for my car. Right. It wasn't for my retirement. Right. I wasn't putting money in there. So you know what I did, Cory?
What's that?
I spent it.
How'd that feel?
I spent it on a car. Fine, because that's what it was for. Exactly. But you know, we at Falcon Wealth Advisors, we use a simple IRA, which is similar to a 401k. But that account, Cory, I didn't use for my car, right? I don't use that account for my house or for Rachel's birthday or whatever. Like I use my simple IRA, which is like a 401k, for my retirement.
Yeah, right? That's good. What I hear you saying, Jake, you could check me on this, is that you are, really what I hear you saying is that you're not borrowing money for the sake of consumption. And I think a lot of the times when people borrow money from a 401k, it is for that reason.
Yeah, and it's easy for me to say because, again, I get it. Emergencies happen, but that is more of the reason that you need to build out a financial plan and hire a wealth advisor so that you don't have to tap into that 401k. Because some people, Cory, believe it or not, might be overfunding their 401k and underfunding their emergency savings.
Yep, I believe that. Well, I agree with that, I should say.
Yeah, they might say, all right, Jake, I'm going to put in 20%, not just 6. I'm going to put in 20. And then I ask them, how much do you have in your savings? And like, well, I have nothing.
It all goes in my 401k.
Yeah, so exactly. that's not a wise decision. That's not a smart thing to do. You might think you're being smart, but it's not. And
give yourself optionality. Yeah.
Yes, I like how you've stressed the plan for today's show. And again, it is important, but the plan solves all of that.
Yes.
And what's great about hiring a third party, Cory, is that we can be unemotional because I get it. It's your money. You're working. You have a family. You have a household. You have all these things going on as a client. And we're going to be empathetic to all of that, but we're also going to tell you what makes sense from a mathematical standpoint and what's going to put you and your family in best shape for that financial plan. And yes, we want to optimize that 401k, but we don't want to do it at the sacrifice of messing everything else up in your financial life. So there's a push and pull, there's a give and take here. You have to understand, though, that you should not borrow from that's not an account to set up with the intention of borrowing. That's not what I would, if you go into it saying, oh, I can always borrow, that's not the way you should be thinking. That 401k money should be, I'm not going to touch this money. Yeah, I'm not going to touch this money till I'm no longer working.
Yep.
I put money in my retirement, Rachel's retirement, we put money in there, and that's for when both of us are done working, whenever that is, again, according to our financial plan. But that's it. Money's in there. It's for nothing else. It's not thought of. It's almost like an irrevocable gift to ourselves that we're only going to use it for one goal, and that's to, when both of us want to, stop working in our businesses, that's what we'll use.
Yep. That's really good. Yeah. So I actually hear, Jake, I think kind of taking all this together is that, optimizing the 401k is not about hitting a specific number or getting to a specific, spot in time.
Good point.
Like optimizing your 401k is about making sure that you know what that number actually means when that time in the future arrives. Like, in other words, it's just not about trying to hit some big magic round number and then that's going to take care of all the financial issues. It's more like,
yeah. Hold on though. I got plenty of clients, Cory, that say though, once I get to 4 million or once I get to 5 million, right? So it's okay to have that number.
Sure.
But it all kind of should go back to your financial plan. Like, is that enough for you? But I like what you said.
Because that goalpost keeps moving for people. Once you get to 3 million, like now it needs to be 4. Once it gets to 4, it's like, well, once I'm at 5 million, it's all going to be great.
Yes, and it could always move, and it will always move. And my deal is with retirement is you have to decide, what do you want to trade your time for? Do you want to trade your time for money from wages doing a job you hate? Right? Or do you want to trade your time for money and wages doing a job you love? Right? And that's really that's where the conversation about retirement should start, as far as a time concept. And then we kind of say, all right, well, if you no longer want to trade your time doing X, do you have enough money to afford your lifestyle Y? But I like it, not just thinking 1 million or 2 million or 5 million or 10 million. That shouldn't be your goal. It should be, what do you want to trade your time doing? But I want to be clear. I have plenty of clients that say that is my goal, to get 5 million. And that's fine. Okay. As long as it works with your financial plan is what I think you're getting at. I like it.
Well, my point though is, what happens when you get there? Then what?
Then you retire.
Okay.
Or then you change it to 6. I know, you're right.
That's all. That's all I'm getting at. But I think it sounds like what you're describing, Jake, it sounds a lot like, for somebody who wants to retire right. I think I know someone who wrote a book about that.
That's right,
I think
Cory.
It's all tied in pretty nicely.
Good one, Cory. Yeah, another second commercial here. If you're a big reader, or if you prefer to listen, and I know you like to listen to stuff, or you wouldn't be listening to Upticks right now.
That's true.
My best-selling book, Retiring Right: Smart Steps for Exiting Corporate America, is sold everywhere great books are sold. Pick up your copy today. You can listen to it or read it, or do both, right? So whatever you want to do, it's me recording it, so you get to hear more of me on the audio. So thank you, Cory, for that quick plug. And it's right, we talk about that in the book. All right, Cory, as we land this airplane, quick recap, right? I like to recap of what we talked about. So you brought up tax diversification, which is a good, important starting point, actually, because you got to know, am I going to do pre, after, or Roth? I talked about getting that company match. It's very important. That's free money that your employer is offering to pay you. Please, please, please do your best to take advantage of that. We also talked about asset allocation, right? So making sure you've got the right mix of stocks and bonds, mutual funds, index funds, whatever is available to you, making sure that's lined up. You talked about incorporating it in your financial plan and not treating it in a vacuum or isolated.
Yes, integrate it. Exactly.
It needs to be integrated. I also talked about not borrowing from it. Again, this is not an account you should take a loan from. That should be the last place you're looking to borrow from. And then you had another weird one in there, right? What was that other weird one?
Where I said having a plan you can stick with.
Yeah. Good though. That's important though. Like, again, don't throw out.
It just was kind of saying the same thing, but yeah, go ahead.
Yeah, don't throw your 401k out the window when markets get turbulent. Some people do make that mistake, Cory. They'll stop contributing to it if the markets get bumpy. So yeah, stick to your plan, stay focused. If you need to adjust your plan because your goals have changed, that's fine, but don't let the market influence that.
Yep. It's not just about hitting a number.
All right, another good episode. Cory, you got any personal notes you want to share with our audience before we wrap up today?
Yes, Jake, so a few exciting things. We just took our daughter on our first airplane. So we flew to Chicago and back. That went great. And
how'd she do? Did she cry on the plane?
Nope.
She didn't cry at all.
Not at all.
And,
Zero crying.
Well, I bet that was a fan favorite. You're in first class, right? So
she's a fan favorite. Yeah, the pilot, we landed in Chicago. He immediately was out of the cockpit. He's like, how'd she do? Did she do okay on the descent? Like it was, I was stunned in a very positive way. TSA, airlines, hotels, restaurants, didn't matter who it was that we were dealing with. Everybody seemed to want to help, which was great. That was very refreshing.
Is that because the look of horror in you and Cassie's eyes?
Possibly.
Or is that because you have a cute baby?
It's probably both.
What if your baby was ugly? Do you think they would be willing to help you out?
Some people might think she's ugly. Who knows, right? Like I didn't ask everyone. I don't think she is, but I recognize I'm biased. Like
I think it was the horror in your face.
Maybe. I think I appreciate people wanting to help and going out of their way to help.
Awesome.
So I just wanted to call that out. And the other exciting thing, Jake, is that we are moved back into our home. Our kitchen is just about finished after the renovation we've been living through for the last few months.
What a guy. You buy your wife. She wanted a car. You're like, you're getting a kitchen. So you
yeah, it's what we needed, right? It's great. It's great. So how about you? What's going on with you?
So I had a birthday. Super excited about that. Thank you to everyone that sent me birthday wishes. It's very cool. And Rachel got me a pinball machine, which I'm super excited about. I think it gets delivered here in June. Are you a pinball guy, Cory?
Oh, yeah.
All right. So we'll have to have some pinball matches. We got James Bond themed. Super excited about that. Yeah, it's going to be brand new. So the company's going to let us test it out before they deliver it, which is cool too. So she got me a pinball machine, which I'm real excited about. And then our back patio is coming along very quickly. So credit to our patio guys. If anyone needs a referral for landscape work, these guys have been phenomenal. Rachel is not easy to please, Cory. And she loves these guys. So
neither are you, Jake.
So maybe not. I don't know.
I'm just teasing.
I don't know.
I think you've got high standards. It's a good thing.
I have high standards. So does Rachel. But these guys are legit. What's great is they do what they say they're going to do. It's that simple. They're hard workers, and I appreciate the owners out there doing the work with his crew. Not that I don't need him to be out there, by the way. Like if he was never there, I would still be okay with it because he does such a good job communicating with us. And I really appreciate it. I don't need an update every day, but he's just very, very strong on his communication, does what he says he's going to do, and his crew. So I'm excited to share some pictures once that's done. We're going to have an outdoor kitchen, a pergola at the fireplace. So that's when the Falcon parties are going to start once that sucker's done.
Well, your neighbors are going to be ready for you to get a pool, Jake.
I know. I know. That's way down the road. Those things are that. So
I know.
You're just going to have to come eat a hot dog instead of go swimming, Cory. But
okay, I can handle that.
So, well, thank you as always, Cory. Thank you as always for joining me on the show. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.